It's now time to dissect our topic of the week. What is the real cost associated with investing? One should pay less for passive fund management, but are there real benefits to active fund management? Gentlemen, welcome to the program. I think let's put it into context first. I was speaking with Roland a little earlier. I was asking him, are you a passive or an active guy? It seems that he's moving and shifting more towards being a passive fund manager, right? Is this what your preference is?
He's only a passive guy. He's never been anything but a passive guy. So he's only a passive guy.
You like the action, do you, Kirby?
Well, I think there's a place for both. And I think that's important, is to understand philosophically what you're trying to achieve from an investment perspective, and then trying to find the best way in order to encapsulate those returns. And sometimes that could be active and sometimes that could be passive. The issue, though, is that if you're going to be active, there's a cost associated with that, as there is with passive. But generally, the cost associated with passive is much less than it is with active.
Is it worth paying a premium or an extra amount so that you do get someone who makes a conscious decision about stock picks and asset class choices, or do you think that tracking the market is far better? Roland?
I think you have to be able to do both, and this is nothing new. This is called the core satellite approach to investing. You need to find fund managers that actually do deliver value and pay them for that fee. But we mustn't forget that it's not the active managers that are the only fees in the mix here. There are all sorts of associated fees, and the fund managers actually earn only a small proportion of the total fees that we pay as investors. So indexation is not about active and passive as much as it is about cost saving, and there's a lot of costs to be saved other than just the active fund managers.
Okay, so let's look at how fees are generally charged within the active space. Kirby, give us an indication of what we're looking at.
Well, I think firstly, the industry a couple of years ago tried to standardize the way in which fees actually get shown to investors, and that's what we call the total expense ratio. Yeah. The total expense ratio encapsulates the fee they could charge on average over the last 12 months. And generally in active fund management, there could be a base fee, which is just a normal fee, and then there could be a performance-based fee as well. Sometimes there's a performance-based fee and sometimes there's not. Now, in certain instances, I've looked at total expense ratios where there's no performance-based fee component and where it just hasn't kicked in because returns haven't been good enough, and you see these kind of TERs that are very, very low. And then those can spike very aggressively, just depending again on the kind of performance. Whereas if you look at passive really only has a base fee. And its total expense ratio is pretty stagnant. There's no, or generally, performance-based fees as far as passive funds are concerned.
But how total is the total expense ratio? Because that includes what the fund manager charges and how much he churns the fund, in other words, how much brokers earn out of that. But in addition to that, there are advice fees and all sorts of other fees before you even get into the product. And those can be much higher than the total expense ratio in some cases.
Yeah, I mean, and that is now the issue that you've got around active fund management, and if it really actually adds that much value. As a matter of fact, I've got two graphs or two tables that I'd like to show you. If you have a look at the first table on your screen over there, you'll see 9 funds that I have registered relative to the ALSI. This is now the total return index as far as the ALSI is concerned. So if you look on the far left-hand side of the chart, you'll see the 17-year numbers. Those are the performance numbers for all the various funds and the ALSI. And you can see that the ALSI is number 3 relative to all of those. If you were invested in fund number 1, well, then you were number 10 of the pops over 17 years, and over 15 years, number 10 again. And then your numbers maybe over the shorter period, which is over 10 years, 7 years, 3 years, and maybe over a year would have been slightly better. And you can see kind of how the numbers change for the different funds that you've been invested in. In some cases, if you were invested in fund number 3, you can see that returns there, you haven't had great returns over, say, for instance, the midterm, but certainly over the longer term, your returns have been okay and maybe average as far as your 17 years are concerned. But now the problem that we've got is that it doesn't take fees into consideration because I'm only showing the all-share index. So on an arithmetic basis, if I just show you the next graph, I've basically gone and taken about 0.50% out of the returns of the all-share index, and then you can have a look at the returns. Now, if you just replicated the all-share index and you assumed a 0.50% type fee, what are the kind of returns you would have got? We would have been number 5 out of the 10 proverbial funds over 17 years, 6 over 15 years, 8 over 10 years, and then over the very short term, 7 years, 3 years, and maybe over 1 year, you'd have done much better just tracking the market than you would have actually have been active.
So then it bodes the question then, Roland, do fund managers and active fund managers actually beat the market over the long term?
There are two issues we need to address there. There are fund managers that beat the market, but is the market the right benchmark? And if you think about it, if your benchmark is the most volatile thing, or more volatile than the active fund. So We have very concentrated all-share index. We also have a very concentrated Swix index. MTN makes up nearly 10% of the Swix index. So that kind of volatility in the benchmark is not good to judge whether a fund manager has got skill or not, you see.
So then how do you decide what benchmark you use? Because at the end of the day, you want maximum return. Is it safe to say that
value for money?
Value for money, absolutely. And you want maximum return with the lowest risk. Is
Yes.
that the correct assumption to make? What is the best performing asset class over the long term? Is that not equities?
What you tend to find is that fund managers have an exposure, which we call a beta, that is about 0.7 to the market. So when the market goes up 10%, they only go up 0.7 times that, or 7%. So fund managers naturally are value investors. They're buying cheap stocks. They're more conservative than the index is. So you can't compare them to the index, and especially if they hold cash and the index doesn't hold cash, these things aren't fair and relevant kind of comparisons. So what we do in the industry, at least in the industry that tries to pick managers, is we need to adjust the fund manager's risk profile adjust the benchmark's risk profile to match that of the fund manager. So if the market does 10% and the fund manager's got only as 0.7% exposure, 0.7 exposure to the market, the fund manager has to beat 7%, not 10%. So if the fund manager beats the risks he's taken, he's got skill. If he gives you the risks of the market, then you can use the market. But if he's got less risk than the market, we can't compare those two things necessarily.
But the best performing asset class over the long term is equities.
That's true.
Is that correct?
That is true. Remember that active fund management is a zero-sum game. So for every winner, there has to be a loser, and after costs, it has to be a negative-sum game.
Let's go to bookworm Kirby, who's holding a book and wanting to read.
Well, I mean, that was a precursor. When you asked me, do I want to be on the show, you said, do you read a lot? I said, yes, I do. And I want to introduce you to a book. It's called The Little Book of Common Sense Investing by John Bogle. Now, I mean, in the beginning, Eleni spoke about the Vanguard Group, and really speaking, in 1975, John Bogle was the man that took Vanguard from being an active house to being a passive house, and he really started what was index tracking globally, and potentially did the precursor of what we've seen in the ETF market that we've seen in South Africa as well at the moment. It's called The Little Book of Common Sense of Investing. It's John Bogle, and in here is a chapter called Focus on the Lowest Cost Funds. And one of the points that John Bogle makes is that active fund managers generally churn their portfolio more than what passive fund managers do. If you churn your portfolio 100% every year, a basic rule of thumb is that that'll add an extra 1% to total costs. Now that's amazing, because one of the big caveats of good stock picking is the fact that you can actually buy a stock and hold it for a long period of time. So people that churn portfolios don't necessarily add value. They incrementally add cost, but they don't incrementally necessarily add value. Yeah. And that's why I keep on saying that if you want to be active, then you have to have a philosophical reason why you want to be active, number one. And number two, you have to understand which fund manager is best suited to you as an individual and what you're trying to achieve. And similar in a passive space.
What is the ETF market, exchange traded funds? What is that doing to active fund management? Because we hear, I mean, we've heard some a lot of investors the ETF market, but others, especially the active fund managers that we've had on this desk, really concerned about the impact it's having in their space.
Look, ETFs have grown, but my sort of opinion on this is quite different to the average, because I don't see ETFs as a replacement for active management. I see ETFs as a totally new industry that is capturing certain risks in index format. In other words, you can buy a value index now which captures the value risk premium, or a momentum index, or a resource index, or a resi index, which allows fund managers or hedge funds or whoever is out there managing money actively to quickly get in and out of the risks the way they want to, or hedge those risks by buying derivatives on that index or that portion of their portfolio. So ETFs have opened up active risk management for the first time, which is a totally new industry than active return management, which is something we've been relying on in the past, where we buy into a fund manager and hope over the long term that they're going to outperform the benchmark. So ETFs are not replacing active management. They are allowing active managers to manage risk better.
And then the other problem that you obviously have, if once you've chosen an active fund manager, you're going to have to find a way in order to actually show who's the best fund manager out there, or who do you think can achieve the most appropriate returns over certain periods of time. I mean, let's go back to that table that I showed you just now. And it's the second one. It's when we take some money off the table as far as the all-share index is concerned. And I mean, on average there, the total expense ratio is about 1.29% per annum. The highest there is 1.87%.
Wow.
And the lowest is about 0.60%. And that just shows you the range.
Is that sort of an average range that we're looking at here in South Africa?
Well, I
between
mean,
0.8%.
Yeah, for equities.
And 1.5%, well, even closer to 2.
Yeah, absolutely, for equities. And I mean, once you start looking at this overseas, and this is John Bogle's point where he's from Vanguard, is that it is even more pronounced because the fees that you could charge in the international space is just so much higher in the active space than you are getting charged in South Africa. So actually, the industry in South Africa, I think on average from a fee perspective, is still below that what you can see internationally.
What are you willing to pay, Roland, for an active fund manager? What is a fair number?
I'm happy to pay anybody a performance-based fee if they can beat the benchmark, provided that I correctly measure their skill. That is the challenge.
So based on returns on a yearly or annual?
Based on risk-adjusted returns, yes. But
and then what percentage of that return would you be willing to give a fund manager?
Well, if currently the industry norm is up to 10%, or it used to be 20, it's come down, but 10% is sort of the average performance-based fee over and above a benchmark. But you cannot use cash or CPI as a benchmark because those aren't risk-adjusted returns. And that's where the whole global industry is looking at, is better ways to identify who has got skill relative to the cost they charge.
Could be sitting there with a big smile.
Because
what is your view? Do you agree with that? So not so much paying a fee, but rather relative to returns.
I'm happy to pay an active fund manager for a concentrated portfolio. A concentrated portfolio can beat a benchmark. A generic portfolio with 100 or 150 stocks in will just replicate what the benchmark looks like, whatever the benchmark might be. Because the manager will look at the benchmark and say, well, I'll be a little bit active, but I won't really be that active. So you have a very concentrated tracking error. A much more important thing to do is when you're going to be active and you're going to pay an active fee, be active. Get some bang for your buck. If you're going to drive a Ferrari, make sure there's no Volkswagen engine in it. Make sure there's a Ferrari engine in it. Get some bang for your buck. The interesting thing, again, from this little book, this Common Sense of Investing, is that John Bogle goes and looks at the myriad of total expense ratios for various funds, and he usually finds the ones that charge the most generally perform the worst.
Wow.
So they have less skill for the more money that you charge. And the guys who generally charge less generally show, from an investment perspective, more skill. Now, I mean, he's using an S&P 500 and then he risk adjusts.
Remember, it's harder to
that.
outperform if you charge more because your drag is so much higher on the fund as well.
Absolutely.
But here's something worth considering. There is perhaps no passive investing because as soon as you choose an index to passively track, you are making an active decision.
Absolutely.
Right? You have to decide which index you want to track, and there are many of those. So maybe there is no passive management. There's just cheap asset management and more expensive asset management.
When after the crisis, and we know that ETFs really took off after the crisis and asset managers lost a lot of business globally, are we starting to see that now, that trend retrace itself, and where we're starting to see active fund management being far more attractive than what it was before?
Well, that is probably a very interesting debate because we need to understand that active management is not equally successful at all times. There are times when it's actually much more well, not easy, but easier to outperform than at other times. And you can actually measure this by, there's something called cross-sectional volatility, and basically what it does is it looks at how correlated the shares are in the market. So if all shares are highly correlated, the opportunity to outperform is so much less. And especially in times of crisis, when the market collapses, everything's highly correlated, and outperforming becomes very hard, irrespective of your skill set. So active management works at times better than at other times.
So
and you can actually sort of see that in the market.
You see, I'd probably add to that by saying that in an American context, when you're trying to track or you're trying to manage relative to the S&P 500, you've got far less concentration risk than you have, for instance, on the all-share index here in South Africa or generally in emerging markets. If you just go back, let's just go back to that table that I showed you a little bit earlier on. You can look at the all-share index. You can see how the returns look over 17 years. Ranked number 5 out of 10 funds, 6 out of 10 funds for the all-share index, 8 out of 10 funds over 10 years. But then look how fantastic the all-share does, even after I take costs out of the consideration, over 7 years, 3 years, and 1 year. And guess what? The thing that did well over that period was resources. Resources has done well intermittently, but not necessarily over the very long term.
But that's a benchmarking issue again.
Well, I mean, and that's what I'm saying to you. If you're going to benchmark against the all-share index, it becomes a concentration issue, and it becomes a thing about resources. Resources do well, managers generally underperform that.
If you choose the all-share index as a benchmark, you are consciously making a decision to be underweight resources.
But how many people do it, Roland? Lots of fund managers. And if
No,
they're
no, I
not
know
using
that, but I'm
that, they're
saying-
using Swix.
I'm saying your benchmark will determine your performance,
But
or the
over-
resource
A
component will
conscious, a
determine.
conscious decision in a sense, sorry, to be overweight resources, you said underweight resources.
I'm saying that the resource
Because
factor
yeah.
is actually determining whether you are outperforming or underperforming, not your skill.
Absolutely, because we
that's
know
the
that
problem.
the top 40 index is obviously very heavy. JSE is heavily weighted towards the resource space. Okay, but here we are, we're talking about the theory behind investing and active versus passive. Let's put it into perspective. We've got a lot of talk about default once again. We're worried about debt. We're worried about systemic risk. We're worried about banks not being capitalized. We're seeing a massive liquidation out of various asset classes, including gold. What does one do right now? Is active the way to go, or is it passive? What would you be adopting right now? You mentioned a combination of both up at the top. Is that the right approach to take, Kobe?
Well, I mean, if you just look at it from a market fundamental perspective, at this point, you've got a whole bunch of companies that are selling at really decent valuations globally, not just here in South Africa. If you take that into consideration, you're probably going to find that active fund managers, if provided that they're properly concentrated, could actually do very well over the next 4 or 5 years relative to passive. But the question is, what are you trying to achieve? Philosophically, what is it you're trying to achieve as an investor? And I think that's more important.
Let's ask the equity strategist here. What do you do? I mean,
you should
are you
always-
cognizant of the macro scenario that is playing
Absolutely,
out?
but most people in the world most large institutional fund managers or pension funds have at all times a passive allocation and at all times an active allocation, and they adjust that. And I do think you should adjust more to active at the moment, because we have much more opportunity at the moment going forward for the next 5 years in terms of relative outperformance.